The market is flooded with high-growth, cash-burning startups. So why is a 75-year-old boring auto parts company, Tenneco, going public, especially when their revenue fell 10.6% last year? It seems like a terrible time to go public. But here's the one-two punch that reveals the real story. While revenue dipped, their net profit grew by 32%, and their return on capital employed, or ROCE, hit a staggering 56.8%. This isn't a growth at all costs IPO. This is a deep dive into a cash printing machine. And today, we're going to find out how they do it. Tenneco is a Tier 1 auto component supplier. That's a fancy term for a company that makes essential parts and sells them directly to car makers like Maruti or Tata. They have two main divisions, Clean Air, which is everything related to your car's exhaust system, and Advanced Ride Technologies, which is your suspension, the shock absorbers and struts. This business is boring in the best way possible. Their first moat is OEM lock-in. When Maruti designs a new car, they design it with Tenneco's exhaust. That contract is now locked for 3 to 7 years. You can't just swap suppliers. Their second moat is the aftermarket, the repair market. When new car sales are down, old car repairs go up. This provides a perfect, counter-cyclical balance. So let's look at the numbers that define this IPO. As you can see from this chart, revenue in FY25 actually fell to 4,890 crores. But at the same time, the green line net profit shot up to 553 crores. This is the central mystery. How do you make more money while selling less? The answer is margin expansion. They got smarter. They focused on selling more high-value, premium products, they controlled their material costs, and they squeezed more profit out of every single part they sold. Their EBITDA margin jumped from 11.8% to a very strong 16.7%, and their net profit margin hit 11.3%. But this next chart is the real story. Return on capital employed, or ROCE. This number tells you how efficient a company is with its money. In FY25, Tenneco's ROCE hit 56.8%. To put that in perspective, for every 100 rupees they invested in their factories and operations, they generated 56.8 rupees in profit. That is an elite level of efficiency. Their other secret? A world-class cash conversion cycle of just 13 to 22 days. In simple terms, Tenneco gets paid by its customers, like Tata Motors, long before it has to pay its own suppliers for raw steel. This means the business is constantly generating free cash. It doesn't need to take on debt to grow. So, are these numbers actually good? Let's compare them to the competition. Against peers like Bosch, Uno Minda, and Gabriel, Tenneco is in a league of its own on profitability. Its 16.7% EBITDA margin and 11.3% PAT margin are at the very top. But its 56.8% ROCE is in a different universe. This is a best-in-class operator. So we have a high-efficiency, cash printing machine. This IPO is a slam dunk, right? Not so fast. There is an elephant in the room, and its name is the electric vehicle. Tenneco's main business is clean air, exhaust systems. Electric cars don't have exhausts. This is the EV substitution risk, and it is the single biggest threat to this company's future. So, is this a company with a built-in expiration date? Not exactly. First, their other division, Advanced Ride Tech, is a winner. EVs are heavier than gas cars, so they require more robust, premium suspension. That business will grow. Second, a huge part of their portfolio is in trucks, tractors, and off-highway vehicles, where EV adoption is decades away. And third, the aftermarket is massive. The 300 million gas cars on India's roads today will all need replacement exhausts for the next 20 years. So why are they going public? This is critical. The DRHP shows this is an offer for sale, OFS. This means Tenneco India, the company, is not raising any new money for itself. The parent company in Mauritius is simply selling its existing shares to the public. This isn't an IPO to fund future growth, it's an exit for the parent. Let's put this all together in a SWOT analysis. Strengths, that elite 56.8% ROCE, high OEM lock-in, and the stable aftermarket. Weaknesses, the 10.6% revenue dip, dependency on the parent for R&D, and the obvious exposure to the death of gas engines. Opportunities, pushing more premium suspension and growing the high-margin aftermarket. Threats: a faster than expected EV adoption and commodity price spikes. This brings us to the final verdict. This is not a hyper-growth tech IPO. You are not buying a lottery ticket. This is an IPO for a stable, mature, cash-printing machine. You are betting that its profits from exhausts, commercial trucks, and the aftermarket will continue to flow for decades, even as the EV market grows. The bull case is that these high margins sustain, the aftermarket grows, and the EV transition for trucks remains slow. The bear case is that EV adoption in trucks happens faster than anyone expects. Because this is an OFS, this is not a buy at all costs IPO. This is a classic subscribe if the price is right deal, for an investor who wants a high dividend, cash cow business, not a 100x rocket ship.